Welcome, dear listeners, to another episode of the Solfate Podcast, where we chat with founders and builders in the Solana ecosystem and in the blockchain space more broadly. Today's episode was a great one with Tommy, co-founder of PsyFi. PsyFi started in the early Solana days. They're pioneers in the DeFi space. They started with an early options primitive on Solana. Super fun stuff. They won a hackathon in early 2021 and went on to sort of found their company and raise and build out a bunch of products since then. There's a whole lot of cool stuff. Tommy himself has an electrical engineering background. He transitioned into software. I don't know exactly when. He says it in the episode, but I've forgotten specifically. But transitioned into software and then transitioned into crypto and specifically into sort of DeFi. So he's kind of a jack of all trades between hardware, software, crypto, finance specifically. It's a really cool conversation.
Yeah, it was super fun. Like Tommy, I always appreciate a good story of like someone switching industries, and Tommy definitely did that, going from electrical engineering to eventually landing in effectively DeFi and finance. And in full disclosure, this episode gets very technical for the financial world, like not our normal sort of technical. A lot of financial terms get thrown around, so don't be afraid of those. Like just help yourself get a little bit educated on it. And yeah, I think PsyOptions is really cool because like one of their new products they're going to launch is Armada, and it really seems to aim to bring liquidity into the Solana ecosystem and help with better tokenomics at a lot of projects, kind of like some sort of platform to actually launch tokens and launch good tokens is like the gist of it. And yeah, I think it'd be really cool. It'd be great for the ecosystem to have better tokenomics and all of these random tokens that projects actually create. So I think it's going to be cool when it launches. So check it out.
Yeah, good stuff. There's also there's some incidental history lessons along the way. Tommy's been since the beginning, so we learn a lot about how DeFi has evolved over the last couple of years. What it was like to be running a DeFi company over the last 12 months, which has admittedly been a bit of a rocky time frame. So really cool to get his take. But without further ado, let's dive in.
Nothing in this podcast is or should be considered financial advice. Any opinions and thoughts expressed are solely those of the individual. They do not represent the opinions of any entity. Enjoy.
I got into crypto back in 2016, 2017, doing some Solidity work, minor investing, and then went full-time, it was a little over 2 years ago now, but got into Solana and started developing on Solana 3 years ago, pretty much to date. So I've been around the Solana ecosystem for a while.
Nice.
Yeah, long time.
Yeah.
That's sweet. Well,
before Anchor was there, before there were docs, way back.
Yeah. Fun
yeah,
times.
I was taking a look through the PsyFi PsyOptions website, and there's a lot of mentions of Serum and hackathon submissions around the Serum submission timeframe. So I thought that was very interesting because, like James said, like I also have very little context on you as an individual or PsyOptions and as like a product. And so I'm curious to hear the backstory of like how PsyOptions also started and what's the backstory on the company.
Yeah. So my twin brother and I, actually, he was working for Blockfolio at the time. And we started paying attention to Solana because we were following Multicoin and saw Kyle Samani posting about Solana back in 2018, probably 2018 or 2019. And then when they went to mainnet, we were spun up an organization and on GitHub, and we're like, let's just start hacking on some stuff. And then Solana did their very first hackathon in November of 2020. And we actually didn't place in that. We built like a third-party trusted Oracle system, kind of like the very beginning of what like Switchboard is today, where you kind of create some parameters and then this network could actually pull that data on chain for you. Didn't place it all. All we had was like a terminal just spitting output. That was our submission. So we would show like how it was working. But like fast forward a month and we wanted to automate an options trading strategy in traditional finance, but our brokerage wouldn't give us API access. So we're like, why don't we just build this into blockchain? It'll be fun. Let's figure out like how you define an option, what an option contract actually is. And that was like what really got us into fully into Solana. We ended up placing first in that hackathon alongside Mango Markets. And as soon as that happened, investors were just like reaching out. We had no plans to create a company or like take this on full time and just go all in. But when you have people kind of like offering you, money and telling you how big this thing's going to be, it's kind of hard to just say no. And so it took a while to get like all the entities set up and legal structure and plans for a future token. That was like about 6 months, and then we were full in and raised some money. Fast forward, timeline over the last like 2 years, we shut down the original like options trading that was like order book based trading with options because there just isn't enough demand there. There's not enough on-chain volume. There's not a ton of volume off-chain. You see a ton of volume in perpetual futures and spot, but not so much like the options market. So then we teamed up and acquired Tap Finance out of Singapore, who started leading like our structured products arm, and we've been running those for a while. We built a over collateralized borrow lending protocol that take those structured product tokens as collateral, so you can get more capital efficiency there. But then as the macro environment has changed and interest rates have like skyrocketed, the risk reward on some of those products weren't worth it to a lot of investors. A lot of TVL kind of got sucked out of there. And so we started shifting focus into a couple new products. Right now we have kind of 3 initiatives that we're gearing up to release. The first one is a new platform called Armada. It's supposed to kind of answer, this is like a partnership with the Hero team. It's supposed to help teams launch tokens, then also get better liquidity on those tokens on chain. We want to make on chain the best place to trade these tokens. And then also help with like incentivization mechanisms to bring more liquidity to those new pairs. The other aspect is kind of tokenomics. There's not a lot of great tokenomics puzzle pieces. Well, there's a lot of puzzle pieces, but they don't come together in the Solana ecosystem very well. And then lastly is an options-based AMM. And so that's kind of what we're focused on right now. We've got the structured product stuff still rolling, but we kind of need to fill the gaps for different environments, right?
I want to maybe drill into each of those pieces that you mentioned separately.
Yeah, I know that was a lot.
I mean, look, it's all great stuff, but we want to make sure listeners understand what we're talking about. And frankly, I want to make sure I understand what we're talking about.
I definitely only understood about half of those things. So like, we'll circle back to each of them individually for sure.
Yes.
So for the sake of, emphasizing the thing that matters most to your company right now, maybe you choose which of those we should talk about first and spend the most time on.
I think the highest conviction we have is the Armada platform, because I think when you look at the Solana ecosystem, the biggest issues facing it right now is lack of high quality tokens with quality value accrual tokenomics, and just on-chain liquidity. And that's the goal of that one.
So let's talk through what the Armada program is and what it what's its purpose, how does it function, how do people get involved?
Yeah, so it's a culmination of probably 5 programs at the moment. The first one is a liquidity bootstrapping curve or virtual liquidity bootstrapping pool. If you're familiar with Balancer, it kind of takes a lot from that. That allows teams to kind of create their own custom auction style and curve. So you could create something where you start a price out really high and it decays very quickly over time until buyers come in, and then price moves up when buyers come in, and then if buyers stop coming in, it starts going back down again. And so that way it's about launching tokens with price discovery, as well as like raising funds for a team. The second component is then where we get into like the on-chain liquidity, and that's what we call a concentrated liquidity market making program. It sits on top of concentrated liquidity pools like Orca's Whirlpool or Radium's concentrated liquidity pools. Basically, if you're not from the Solana world, Uniswap v3 programs, and delegates the market making capabilities to an institutional market maker. And with some like technical advances of this, you can get your TVL can go a lot further as far as liquidity on chain, because you can have tighter spreads and more liquidity around the current price, and more active management styles. And as a user, you don't have to manage it yourself.
Can I ask a question about something you said? You mentioned it delegates some of the liquidity to like an institutional provider. Can you elaborate on what that entails, what that means?
Yeah. So it's a non-custodial, essentially 0% interest loan to a market maker. Basically, basically users are pooling their capital into a vault. And then the market maker is the one that actually opens and closes positions, sets spreads or position bands, and adds or detracts liquidity from those positions. So they're basically the market maker has permissions to manage the liquidity on uh, the the concentrated liquidity pool or market, if you will. Does that answer your question?
Yeah, I think so. Cool. Sorry, didn't mean to interrupt. Just wanted to make sure I grasped that piece. So
No,
you can
you're
pick
good.
up where you left off there.
Yeah. Well, I mean, that one's the biggest one. I think it's the most, that program is the most fun. We've just been running some internal testing so far with like other liquidity and, just the volume on Sol USDC pairs alone makes the returns very worthwhile. So we think that one will be really cool. That's the one where we want better market making and more liquidity on chain. So instead of getting into bonk by going to a centralized exchange, you should be trading on Solana, right? Like that's how we're going to pull new people into the ecosystem when they're forced to get involved in this new community by trading on chain and getting exposure on chain and then seeing how fast their trade settles. That's what kind of opens the eyes of others, right? And then the other pieces to Armada, the other programs are a new kind of discount token standards is what we're calling it. It's an incentivization mechanism where you can incentivize pools instead of just giving the spot token, you can give a 20% perpetual discount to that token. So let's say the token is trading at $1 today and you're airdropping a 20% discount. Basically, you would have to pay 80 cents to get that token. Now, if the token trades is at $2 tomorrow, and then you go and want to exchange, you would have to pay $1.60 to get that token. And so it give projects or token issuers the ability to have more variable incentive mechanisms, and those fees go back to their project, back to their treasury or wherever they're directing it. So they can continue their operations and whatnot.
So does Armada actually give? I would assume like you get like full UI, so that way, sort of like how the Realms application gives a UI for like governance and some like multi-sig kind of support. Does Armada give these types of like user interaction, user UI to actually manage all of this, like an end-to-end solution for any project wants to launch a token for whatever reason they have, and you can both see the analytics and you can see all these curves and like really nice UIs too?
Yes. So, I mean, and well, the one thing we're actually doing too is allowing it to be white labeled. So you could we can export a static site, host it as an XNFT or somewhere else, and make it customizable to the team. Because right now it's those three programs, but we are going to bake into the tokenomics aspects, and we want to make it so you're not just seeing, oh, you launch a token, you've got now some liquidity, and you've now launched your actual project or what your organization's been working on. But then you can start layering in tokenomics, so it plugs into governance. So like a single-sided staking that plugs into SPL governance, and then a few other programs, and kind of see like your holistic organization and how tokens flow throughout. That's definitely that's like the V2. But yeah, the UI will be given to everyone.
Got it. So the target customer, rather than being sort of everyday DeFi user, is organizations who want to launch and manage tokens.
There's multiple user personas here, right? Like the primary persona that we're going after right now is people who are trying to launch tokens. But once you actually have a token and you've set up tokenomics and whatnot, the other persona for the concentrated liquidity market making vault is your actual community members, right? And so the best channel to get to those people is through the team and through that organization. So that's kind of why we see targeting the project founders, the organizations, or kind of key decision makers there as the like cornerstone.
Got it. I wanna maybe. I mean, generally speaking, tokens are an interesting space in 2023, right? End of 22 was a challenging environment for crypto, very very broadly, but especially on Solana. I'm curious, like you and I lived through very different experiences, right? It's like I lived through an experience where I had a small to like very small amount of Sol, frankly, on chain, and that was about it. Maybe some NFTs, just like your standard. I don't have a lot of capital, so I just have like a small amount of tokens. And so when things crashed, it was like wild to watch, but didn't feel like I had a ton of skin in the game necessarily, right? Very different experience for you. I would love to hear what that was like for you.
Yeah. Oh man. I mean, I think it's there was like one crazy event, like a different catalyst every quarter for the last like 4 quarters, right? Or last at least 3 quarters. Like it, so it was just like one like oh shit moment, and then a step down to an oh shit moment, step down to an oh shit moment, step down. And honestly, I think like I'm like a horrible trader. Like this is why I need an institutional market maker to like manage these positions for me, because I wrote it all the way up from like 3 years ago and all the way down, right? I went from a little bit of money, just putting the toe in, to like, oh my God, this is a lot of money, to like, we're back down to like, it's more money than I had in the beginning. But so I've been just like holding through this roller coaster. I think the like the tough thing, like the lesson learned is like, okay, you need to like pay attention to like the signals and like the top. And I kick myself for like not taking some risk off at that point. But I think like outside of the personal holdings and investing, purely investment, I think like from the development standpoint, the ecosystem got a lot more quiet. Like it's really hard in the bull market. There's so much noise. There's so much competition. My code was forked multiple times. People who were friends became competitors and direct adversaries, and would like stab you in the back. And you're constantly like just building and spending 12 hours, 5 days, 6 days a week building and talking to people and whatnot. So like there was good and bad in both. And I think it just kind of became net neutral over time. If I look at it, from where we are today, like I have more of a personal life right now, and I'm still maintaining and still like building a lot of stuff, and the team's still pushing stuff. So
interesting.
I don't know. Yeah.
From a company standpoint, you've mentioned liquidity a couple of times. I imagine liquidity changed drastically over the last 8 to 12 months. How has the company managed that?
Yeah, well, I mean, first thing, we're fortunate enough to raise a lot of capital in 2021, and we didn't like overhire. We don't overspend on engineers. We are never paying egregious amounts. We trained most of like all our smart contract developers. Like we've trained ourselves. Just took good cybersecurity professionals or things like that. And so we never tried to chase insane yields. We never put, $1 million or $2 million into Anchor. And, we never were writing uncollateralized loans or things like that just to try and squeeze some yield. So I think capital management was like a big key thing, but like we're still in the position from longevity of building back operational, like working like cash flow, right? Like that's the really tough thing right now. And so that's kind of why we have so many like irons in the fire to kind of build for the current market as it has changed from the past and the future market.
Got it. No, that's great. I mean, capital management is key, I think, for anyone starting a new venture. It's easy, especially at the height of the bull, to spend like crazy, right? To be like, oh yeah, this money's flowing, everything's good. we can
Yeah.
we
It can only go
we can
up,
spend
right?
some to
Oh,
make
wait.
some, and then all of a sudden you're screwed. So glad to hear that you guys weathered that storm fairly well, due to like your own fiscal responsibility.
Yeah.
I am I am sort of curious, is a bull run, right, is kind of fueled by hype and speculation, and a bear market often is is fueled by the opposite, right? Is like fueled by fear and hesitancy, and so you sort of lose liquidity. There's a wide spectrum there where sort of where reality exists. And what I mean by reality is sort of like the true indication of the demand for crypto products, for for tokens, etc. But it's an incredibly wide band, and it's hard to say whether that sits smack dab in the middle, closer to the top, more towards the bottom. Though people like yourself who sort of are work in the DeFi space very intimately might have a better pulse on what is the actual demand for DeFi products outside of pure speculation. I'm curious, like, where do you think we are today in terms of true demand for crypto products, and where do you and from a trend perspective, like, where do you see it ending up? Is this is crypto and I'm gonna say DeFi specific, is DeFi meant to be a niche financial sector, or is it, or do you think DeFi is meant to be uh, maybe not a full replacement for TradFi, but meant to exist on the same scale?
I think it's going to be somewhere in the middle of niche and like full scale of TradFi. I think like the global, I'm assuming, are you guys both US citizens?
Yeah.
Yeah. So like, I think for us, like, we don't run into headaches with the like traditional finance or lack of banking or lack of accessibility to certain things unless you're going and asking for API access or trying to get direct order book based data, right? Like, you don't hit walls unless you're going to some weird deep corner that you need to be working at a big incumbent to get access to. But on the global side, like, that's not really the case, right? So I think like the actual use cases of DeFi and this globalization, like currency layer and financial layer, will be driven by other markets and other domiciles. So, but I think like going back to like the hype, it is very tough to like be a realist and maintain. And I think that's where you have to, we haven't done any real like liquidity mining initiatives or points or things like that because, and the reason we don't, or airdrops, and one, outside of like legal questionality and things like that, making sure you're doing things like from a proper legal perspective. The other issue is it can kind of skew like, is this demand for, actual demand for the product and the risk reward profile, or because we are paying people to use this. And we have some low float token that has a high value that's just going to tank as we release supply, right? And so that's a little bit of how like we try and keep things real to determine whether there's actual demand. And then the other thing is like going by the one-on-one conversations. Like, you can learn a lot more chatting with people one-on-one and doing BD rather than trying to do broad level marketing and like hype to like pull people in. It's a lot easier to gauge interest from talking to institutions or other people, because there is a lot of value to be captured on chain. Like, there's a ton of volatility in these assets. It's just people don't, it's hard to actually, as an individual, to capture that value.
Yeah, I mean, like, well, so aside from the West, snuck in there. Aside from the developed West, like you said, like, as U.S. citizens, like, generally speaking, we trust our government. We're not afraid that our government's going to steal all of our money. There's naturally some edge cases, and like everyone has their belief system and parties and all that kind of stuff. But generally speaking, like, our financial institutions are stable, right? Like you said, it's not necessarily true for the rest of the world. And with the regulation that also comes with a lot of these things, like, where do you factor in these regulatory hurdles, for lack of better phrasing, both between the developed West or like developed countries vice developing countries? So like take Africa, for example. In most regions in Africa, people don't have access to they have access to hardly any financial services, whether that's banking or just even simple peer-to-peer payments or simple, I guess, centralized payments. So they have to rely on peer-to-peer payments. They have to rely on their telco company to facilitate these payments back and forth between other companies, like you're paying random bills, or if they're buying the coffee at the coffee shop down the street or sending money back and forth. So like, where do you think that this kind of falls in with the crypto DeFi scene? Like, what are your thoughts, especially since naturally you guys have a product and a business that's very entrenched in the DeFi ecosystem?
Are you talking more about what makes the good use case, or like what product specifically would help those sort of countries or jurisdictions?
I guess my question is kind of both, but more so on the products and like why they should trust them and how to convince them to use the technology, because
Yeah,
it's harder. It's probably easier to convince people that don't already have a stable financial system to use it, but people are still not on a global scale adopting it as fast as those of us that are already here would kind of expect.
yeah. Okay. So I think there's like a few things, right? When we talk about just where to put money in general, ignoring like the kind of where you live and whatnot, and what access you have to financial products, but like you have to evaluate like risk and reward. And like with blockchain, I'd still say it's in its infancy. I mean, specifically Solana too. Um, there's still a ton of smart contract risk. There's not products that have been around, or smart contracts that have stood the test of time for 5-10 years right now. And so you kind of have to bake in that percentage of return that's required to take on that risk of smart contract risk. And with treasury yields so high, you have to pass that threshold on top of the treasury risk-free rate of return. And so just kind of highlighting that there's other risks in the system. And as developers, right, for us, like we can read these contracts if they're open source and analyze them and build our trust. But like the layman, like does not have access to that. And it's hard, I think, we had Anchor's repository for like open sourcing stuff, and that was great for making sure things are open sourced and validating that what's on chain was actually what was published to that Anchor repository. But it's still like to the layman, like what the hell are they looking at, right? How do they determine if this thing is safe or not? And you have no idea if the people who peer reviewed it or the quite frankly the auditors who put out some PDF that says they reviewed it actually caught any security vulnerabilities, right? So there's still just like a ton of risk in making sure that things are transparent and whatnot is very difficult, or at least so a layman non-developer could like read it or understand it. I think that's like a very difficult problem. But I think like if you have less options, right? Going back to the like geographical or geopolitical like part of the question, if you have minimal options and you don't have access to US dollars or the US dollar and risk-free rate of return, and you don't trust your currency, or it's going through some crazy inflationary period, then your risk tolerance may be lower. But then you still have to onboard and make sure that you can onboard and make sure that there's on ramps and off ramps and you can put your money in and get it out seamlessly. And I'm sure there's a ton of work being done on all those fronts. It's a little bit easier to solve, I think, than like transparency of like programs and risks. I think that just takes things being baked in over time. But so I think that's kind of the equations, or at least how they're evaluating these things, right?
Is I feel like anytime there's great yield somewhere for any kind of extended period of time, it's going to start out primarily as individuals, and eventually it's going to shift to institutions, right? And crypto, there's kind of this driving ideology behind crypto, which is democratization of opportunity. That just sort of naturally goes away when institutions flood a space due to the imbalance of capital available to each of those parties. I'm curious, do you think that it currently happens in crypto? And you know, if not, do you think it will? And how is there any way to sort of maintain access for both individuals and institutions separately, so that there can be some kind of like equality of capital opportunity?
I think like on a dollar per dollar basis, like you can get the same opportunity, but well, it depends. So let's take like an example where yield is unsustainable and there's some liquidity mining program and something like that, and you have these whales that like come in early and heavy and they just suck up all the rewards, right? That's not really sustainable. They're gonna get, and then they're gonna dump that token and make all the money, and retail typically ends up holding and losing out there. So like I don't think there's a way to fix that problem. It's just in current environment, like institutions are not getting involved in that kind of stuff because it's either not worth their time, they're risk adverse, or whatever. But I think when you look at like liquidity and capturing, like market making and democratization of like market making, if you have this, like let's just use Armada's concentrated liquidity market making vault as an example of like capturing quality yield from the volume based on SOL and USDC. Over time, like if institutions see you can make 30% APY, you're going to like come in and like deposit a ton, there. Volume's it might still be high, but volatility is going to go down because there's a lot more like liquidity on this market. And so trades don't move the needle as much, and that APY like moves down. But everyone on a dollar per dollar basis is still, pooled together in a sense. And so you're getting the same amount, but you don't have near as much capital as the institution. So you were making more before they came in, and now you're making less since they came in. I don't think there's a way to really like I don't think you can like solve that problem. It's just a fact of when there's money to be made and it's worthwhile, like they're going to come in.
How, the first piece you mentioned, right, about like retail investors sort of absorbing exit liquidity for more sophisticated investors who make it into a thing early, is there a way around that, right? Like, is there a way to educate sort of your typical investor in the space such that doesn't happen as often? I feel like that is largely responsible. Look, in addition to the things that have turned out to be actual scams in crypto, there's also things that aren't inherently scams, but do screw over your sort of typical retail investor. And it's not because it was set up as a scam. It's just, it's poor tokenomics. It enables whales to come in and soak up a bunch of the early liquidity and then dump it later as there's hype, right? And sort of people with less money and less financial sophistication get stuck holding the bag. And it's that absolutely contributes to feeling like the entire space is a scam, which is unfortunate because, to your point, Tommy, there is an immense amount of true value on chain, right? There are DeFi operations that make genuine sense, that enable things that weren't enabled before, but it gets overshadowed by this sort of sense that everything in the space is a scam. And so what I'm curious about is, in the couple of years that you've been building DeFi products in the space, do you see a way to better educate people so that doesn't happen as much, so that there's less of this like big hype boom followed by a drop where you know, your retail investors get stuck, or get screwed basically.
Yeah, I mean, I think obviously education can help. You know, you get burned a few times and ask why you're getting burned and actually pay attention and realize you'll learn pretty quickly. I hope a lot of people have learned thus far. But I think it comes down to like what Nick, you know, chimed in with is like poor tokenomics and poor like thoughtfulness of the token. Like when you think about like the liquidity mining stuff where you're just dumping, you know, amounts of tokens into liquidity pools and whales are just sucking it up and they're just notoriously selling as soon as those tokens come in. I mean, they're going to have that process automated, and retail's not going to be able to keep up, and you're going to see that quick boom and bust of that token, right? So I think it's more about like thoughtful incentive mechanisms, thoughtful tokenomics of how does value accrue back to the token, so that way you can make sure the outflows, you know, or the selling pressure is offset by some sort of buying pressure coming from some sort of value accrual tokenomics. You can create equations that, you know, kind of net out and kind of weed out the people who aren't holding tokens and, or, you know, people who are dumping and making sure tokens end up in the hands of people who are holding. So it's really just, and I think that's like the V2 of Armada is like focused on tokenomics and how it plugs into governance and all that stuff. Like it's a real problem. Like we wrote an article in 2021 about, it was July 2021. We analyzed a bunch of airdrops, and the best thing to do with every airdrop, except for maybe Uniswap, was sell immediately. Then we wrote about how you could use options and option airdrops to kind of offset some of that and reduce sell pressure by giving slightly in the money or at the money options. But we've seen pain points of like options are very complicated users, so and things like that. So, you know, I think that's where our mind's shifting to next.
I would love to see like a platform that is designed to guide the unsophisticated investor, right? Like a platform that sort of helps you learn the crypto investing space and be more careful about your trades. I think, you know, it's like traditional brokerages will, for example, not let you trade options or not let you trade on margin until you have some kind of track record, or they have other proxies like total amount total amount of capital you've got holding with them, that sort of thing. They're very crude proxies and they don't work very well. But it would be cool, I think, to see a platform in the crypto space that is truly there to like help out your regular Joe Schmo investor.
Yeah, I think that'd be very cool. Like, if you have ideas, I mean, I'd be down to hack on it. I need to think through like specifically.
Yeah,
like,
I don't really know what it is either. It's like coming to me right now, I guess.
Yeah, I have ideas on like transparency of like how tokens are flowing through an ecosystem, and that's something that we're going to work on in this V2 is so you can see, because like right now in Solana, users like things don't really plug in well to like SPL governance and whatnot, and so users are now kind of, okay, I got this token. Do I stake it and earn rewards? Do I provide liquidity on exchanges, or do I participate in governance? And you have to like make these decisions. And if you're participating in governance and tokens going down, well, then you have all these other headaches, like hurdles to like actually sell out and reduce risk or manage your risk. And so we're trying to at least streamline that decision and make it very like clear to users. If you're a part of X ecosystem, here's how the token flows. And like, here's how, you know, the best way to be involved in this ecosystem, which I think is a missing piece. But I think to your point, like the education on, you know, how not to get burned by seeing a high APY on some pool that's doing some liquidity mining is critical.
Yeah. I also feel like there needs to be some delineation between types of tokens, right? Like not all tokens have the same, like they don't exist to serve the same purpose, right? A PFP NFT is not the same as the NFTs issued by Helium that are like representative of your physical devices that are using the network, which is not the same as a traditional governance token, which is not the same as Sol, which is a native token that incentivizes the entire network to function. Like, they're all different categories, and yet from an investing standpoint, we kind of treat them all the same, right? We're just like, yep, token, we want token value to go up. That's the end of it. Whereas,
yep,
and to your
proxy.
Exactly. And, well, and to your point, and to your point, Tommy, sorry, like, this is all kind of coming full circle, right? Like, a lot of that is the responsibility of the organization putting out the token to put in place the appropriate guardrails, to put in place the appropriate tokenomics, to incentivize the behavior that makes sense for that token. It might not make sense to have a governance token that is easily tradable, right? It might make more sense for that token to be fairly locked down and difficult to trade, or maybe not even possible to trade in a financial sense. Maybe it's like it's a giveaway thing based on other governance votes, or I'm just throwing out a bunch of random ideas right now. I'm not, if listeners, if you hear me say something you disagree with, like, I'm not asserting correctness here, but just generally speaking, right? It's like I think we've gotten really stoked about this high liquidity. The fact that crypto can enable highly liquid transactable tokens, and maybe not thought about whether that makes sense for all token use cases, because there are some where it's like, yes, we just want the least amount of friction possible for trading this token, and there are other tokens where that might actually be harmful to the purpose of the token, so
yeah,
just I don't know, random one-off thoughts on a Tuesday.
Yeah, I mean, I think with Token 2022, maybe we'll see more like unique stuff, right? Like that kind of restricts liquidity or buying and selling or things like that. I think it's definitely possible in the future. But yeah, it's an interesting point.
Well, let's see. I want to maybe like ask some more personal questions, like pivot back to sort of your intro and just kind of chat less about the tokens and views on crypto generally, and just sort of talk about your experiences. You mentioned that you started off as an electrical engineer and then got into software, and now you're still in software, but you're also like very deeply enmeshed in finance. Okay.
Yeah.
And working with financial products at a very sophisticated level. That is an interesting path, my friend. So let's, if you don't mind, I'd love to dig in and like maybe understand the steps there.
Yeah. I mean, all right, we'll go from hardware engineer to software engineer. That one was pretty short and easy. I did a few internships and had a job at a telecom or satellite internet company, and working on their like team that builds their modem, does like signal testing and whatnot. And it was like a 2-year life cycle to like release a new piece of hardware, from like start to finish of like, and you're doing a couple of like projects at once, but like it was like a long life cycle. And I'm like, all right, it takes like 15 people, 20 people to like bring this hardware to market. And then like there's a bunch of software engineers that have to program it. And I was like looking at the iPhone and things like that. And it's like app developers are making a killing, and it takes a small team to make the hardware, but then, you need tons of demand. You need tons of software engineers to build the apps and build those things. And so that was what was kind of led me to like pick up software engineering, along with my brother and a good friend of ours. We were starting a company in college as well. And so we wanted to learn and build our site and application ourselves. So those two things kind of led us to like forgetting electrical engineering, mechanical engineering, and like jumping into just more high level programming. We started with like Ruby on Rails.
Okay, I was just about to ask that. Was like
I figured. Yeah. I knew a little bit of C, like very little, from like the hardware stuff and like how to interface with some things for EE and the work, but I was by no means like a good low level like C programmer. So like Ruby was like, wow, you could Ruby and I don't even think we were using React. I don't even know what framework we were using, but it was just nice to like make something and see it on your screen rather than like
Yeah.
dealing with C and just compiling in some terminal output. So
You got to compile it, send it over serial to your actual hardware, and then you're like,
oh
oh,
my God,
did it
yeah.
work? I'm not sure.
Nick,
Well,
were
it
you
didn't move the
electrical
servo.
engineering too?
Like, okay.
Yeah, you sound like, you know, did you study EE or something?
Not formally at college. As part of my 10 years in the military, I went through the submarine nuclear program, which we get a lot of education on electrical engineering and nuclear engineering.
Nice. Yeah. Did you enjoy that?
Yeah, it was fun. It was definitely a different life than I live now. A lot of good memories and, you know, interesting lifestyle that very few people around the world have ever seen and will ever see. So it's unique, I guess.
Yeah, that's cool.
Nice. So, when did you start getting interested in like finance?
So always been, you know, a retail, you know, I'll just call myself a schmuck, a retail, like, you know, I'm not a good trader. I've realized that. And I still think I still try to trade, but I'm just not great. I do better when I let code make decisions rather than myself or my emotions. But no, I think my dad set us up with just like a trading account in early high school, maybe like ninth or 10th grade. And like just kind of paid attention a little bit, didn't do anything serious, but got involved enough to like, to pay attention and know what to look for. And then like options and Robinhood, like was in college. I mean, actually, I don't even know if Robinhood was in college at the time, but started paying attention to options in college, but still didn't know anything. Like it was just more of like speculation and like betting, if you will. Then had the idea, like I think the Robinhood option stuff was like really big like a few years ago when we were like working on the Solana, like the first hackathon. And that's when we're like, oh, let's just try and automate like an options trading strategy and defining what an option was. And started just like picking up like quantitative finance books and trying to read some of those. Also through the, you know, winning the hackathon, market makers reach out to you and you're like talking to them and like you know enough to like to talk, but then they're throwing out some terms that you don't know and you're just like, yeah, writing it down, and then you go and look it up later, find a new book and all that stuff. And so I think it's like over the last like 3 years, I mean, really from like diving into DeFi full time and networking, like you just pick it up as you go. And that, I mean, that's a beautiful thing about DeFi, right? The democratization of this stuff. You can mess with an order book and mess with trading and market making, but in traditional finance, like if you want actual order book data, like you have to pay for that. And like, it's not cheap. And so you can kind of get a much faster learning curve in this world than in the traditional finance world.
I always tell people like, hey, if you really want to get into crypto, the best way to do it is choose a sum of money that you are okay going to zero. Put that money on chain, and then go speculate like just speculate like crazy, because nothing's going to teach you to be safe.
This is not financial advice.
Hey, I said money you're okay going to zero, right? If that's $10 for you, it's $10. If right, like whatever, because I did that without meaning to, and it was more money than I wanted to go to zero, a lot more money than I wanted to go to zero, but it made me a hell of a lot safer, right? I like you, Tommy, I'm not a good trader. I'm still not a good trader despite my many losses, but I'm much better now. Like I don't buy into hype the same way now. And so maybe I don't have like big gains, but I also don't have like the same types of massive losses anymore. I'm just riding the market, a little up, a little down, a little up, a little down. And hopefully in the long run that pays off. But I have become quite risk averse due to losing, like I said, a lot more money than I wanted to. But honestly, I wish somebody had much sooner introduced me to crypto with that advice, with like, hey, do you have $100 you're willing to lose? Cool. Go do random shit with that $100 on chain and learn how liquidity pools by actually using them, rather than like just reading about them, because there's a limit to what kind of knowledge you can absorb by like reading about a thing compared to experiencing a thing.
Yeah,
I totally agree. Yep. That's the best way to pick up engineering, is just pick a project and run with it, right?
Exactly.
Any type of engineering for the most part. Yeah.
Look, and you might get lucky. You might put $100 in and you might not lose it all. So you might keep $5 of it.
101.
Most are not zero yet, right? Well, I guess unless you're jumping into scams. But
one of my first plays was like Iron Titan, and which went to zero. It was like full went to zero. It was hyped as like the next big Iron was hyped as like the next big algorithmic stablecoin. Titan was like the token that was used to sort of trade in and out of Iron algorithmically to keep the dollar peg, and it went bust on like, I don't know, like 26 hours in depeg, and just everything went to zero. And
that's a quick learning curve.
Yeah, no, I was like, oh shit, I need to be smart. What am I doing? It was interesting. In fact, I probably would have just bailed on crypto entirely at that point if I hadn't also experienced some things outside of DeFi that I just thought were fun, right? So it like kept me in the space for the fun of it, not for profit. And then I was able to slowly come back around to DeFi and be like, oh yeah, I can assume a moderate amount of smart contract risk and get a few percent yield that I at the time wouldn't be able to get in like my traditional savings account. Now that environment is flipped because of interest rates, and now a lot of those things, it makes more sense for me to have off chain since I'm in the US.
Still not getting that in a savings account, right?
I've got a 4.5% high yield savings account.
I guess what Fidelity and a couple others have.
There's a couple, and they're pretty good. It's more than I can get staking USDC on chain, but I do still have stuff on chain where I've got other plays, but they're all fairly modest, because again, I'm not looking to have anything go to zero again.
Yeah.
All right. Well,
I'm mostly in treasuries, off chain.
I think on that note, we're getting to time on this, but this has been such a great chat. Thank you so much for joining us, Tommy. And I guess is there any last minute things you want to say before we wrap it up?
Thanks for having me. Check out ArmadaFi on Twitter. We'll be posting updates and going public probably in the next month or so, at least before Breakpoint. I'm just high conviction, really excited for that product given this environment.
Cool, man. That's awesome. Well, thanks so much for the chat. We'd love to chat more sometime. To the listeners, we'll see you all next episode. Thanks, everyone.
Bye-bye.
Thank you.